The second lecture will include the second half of the learning objectives 6 through 10. They include apply accounting concepts and principles, describe the accounting equation and define assets, liabilities, and equity, use the accounting equation to analyze transactions, prepare financial statements, and use financial statements to evaluate business performance. Objective number 6 is apply accounting concepts and principles. As mentioned earlier in the chapter, or in the last lecture, the guidelines that govern accounting fall under GAAP, GAAP, which stands for Generally Accepted Accounting Principles. GAAP rests on a conceptual framework. The primary objective of financial reporting is to provide information useful for making investment and lending decisions. To be useful, information must be relevant, reliable, and comparable. These basic accounting concepts and principles are part of the foundation for the financial reports that companies represent. 5 important principles provide a foundation for accounting. These are the entity concept, the faithful representation principle, the cost principle, the going concern concept, and the stable monetary unit concept. An accounting entity is an organization that stands apart as a separate economic unit. We draw boundaries around each entity to keep its affairs distinct from those of other entities. An entity refers to one business separate from its owners. Accounting information is based on the fact that the data faithfully represents the measurement or description of that data. This guideline is the faithful representation principle. Faithfully represented data is complete, neutral, and free from material error. The cost principle states that acquired assets and services should be recorded at their actual cost. It's also called historical cost. The cost principle means list at the amount shown on the receipt, the actual amount paid. Even though the purchaser may believe that the price was a bargain, the item is recorded at the price actually paid and not at the expected cost. Another reason for measuring assets at historical cost is the going concern concept. This concept assumes that the entity will remain in operation for the foreseeable future. Under the going concern concept, accountants assume that the business will remain in operation long enough to use existing resources for the intended purpose. The going concern principle assumes that businesses won't close soon. The value of a dollar changes over time, and a rise in the price level is called inflation. During periods of inflation, the dollar will purchase less. But accountants assume that the dollar's purchasing power is stable. This assumption is based on the stable monetary unit concept. The stable monetary unit concept means stable currency buying power. The 7th learning objective is to describe the accounting equation and to define assets, liabilities, and equity. The basic tool of accounting is the accounting equation. It measures the resources of a business and the claims to those resources. Assets will always equal liability plus equity. Assets are economic resources that are expected to benefit the business in the future. Assets are something the business owns and has value. Cash, merchandise, inventory, furniture, and land are examples of assets. Claims to those assets come from 2 sources. Liabilities are debts payable to outsiders who are known as creditors. Liabilities are something that the business owes. For example, a creditor who has loaned money to Smart Touch Learning has a claim to some of the business's assets until the business pays the debt. Many liabilities have the word payable in their titles. Examples include accounts payable, notes payable, salaries payable. The owner's claim to the assets of the business are called equity. also called owners or shareholders' equity. Equity equals what is owned, assets, minus what is owed, liabilities. It's basically the company's net worth. Stockholders are the owners of the corporation, so owners equal stockholders, and owners' equity equals stockholders' equity. The accounting equation shows how assets, liabilities, and stockholders' equity are related. Assets appear on the left side of the equation, and the liabilities and stockholders' equity appear on the right side of the equation. So the left side of the equation is always equal to the right. The equity of a corporation, called stockholders' equity or shareholders' equity, is divided into two main categories: paid-in capital and retained earnings. Paid-in capital or contributed capital is the amount invested in the corporation by its owners or the stockholders. Retained earnings is the amount earned by the income-producing activities kept for the business. So it's the retained or the profits that are being plowed back into that business. The basic component of paid-in capital is stock, which is the corporation issues to the stockholders as evidence of their ownership. Common stock represents the basic ownership of every corporation. Retained earnings equals the net income of the company less the dividends. Net income equals the revenue earned by the company less the expenses incurred to earn the revenue. Dividends are distributions of net income to the stockholders. The owner's equity of proprietorships and of partnerships is different. These types of businesses do not separate paid-in capital from retained earnings. Instead, the equity of each owner is accounted for under a single heading of capital. After earning net income, the business may pay dividends, a third type of transaction that affects retained earnings. Dividends are distributions, usually of cash, to stockholders. Dividends are not expenses. Two types of events that affect retained earnings are revenues and expenses. Revenues are increases in retained earnings from delivering goods or services to consumers. Expenses are the decreases in retained earnings that result from operations. Expenses are incurred costs that you will have to pay either now or later. When revenues exceed expenses, the result of the operation is a profit or a net income. When expenses exceed revenue, the result is a net loss. Revenues are increases in retained earnings from delivering goods or services to customers. Revenues are earnings. There are a relatively few types of revenue, including the following: sales revenue. Greg's Tunes earns sales revenue by selling CDs to customers. Service revenue. Smart Touch Learning earns service by revenue by providing e-learning services. Interest revenue. Interest revenue is earned on bank deposits and on money lent out to others. Dividend revenue is earned on investments in the stock other than the corporation. Expenses are decreases in retained earnings that result from operation. Unfortunately, businesses have lots of expenses. Some common expenses are as follows: store or office rent expense, salary expense for employees, advertising expense, utilities expense for water, electricity, and gas, insurance expense, supplies expense for supplies that have been used up, interest expense on loans, and property tax expense. This exercise determines the missing amount in the accounting equation for three corporations. New Rock Gas, we're looking for assets. It has liabilities of $24,000. It has equity of $50,000. The total assets would be $74,000. If you plug in the equation, both sides must always equal. That's what an equation means. So we have $74,000 equals $24,000 plus $50,000. So we've got $74,000 on both sides of the equation. DJ Video Rentals, $75,000 assets. We're looking for liabilities, and we have equity of $32,000. That gives us a liability. If we take $75,000, subtract $32,000, our liabilities are $43,000. Okay, the last one, Corner Grocery, we have $100,000 assets, $53,000 liability. We're looking for equity. When we plug this into our equation, $100,000 minus $53,000, we have $47,000 for the liabilities. Next exercise lists 7 main characteristics of a corporation: continuous life and transferability, corporate taxation, government regulation, limited liability of stockholders, no mutual agency, separate legal entity, and separation of ownership and managers. Which accounting concept tells us that the previous 3 corporations will continue to exist in the future? The answer, the going concern concept. This Objective 8 is using the accounting equation to analyze transactions. First, before we get into this, we need to define what a transaction is. Accounting is based on actual transaction, not opinions or desires. When you start recording opinions or desires, it could be interpreted as fraud. In fact, it is fraud. A transaction is an event that affects the financial position of a business, and it can be measured reliably. Transactions affect what the company owns, owes, or its net worth. So we have assets, liabilities, and equity. An accountant records only those events that have dollar amounts that can be measured reliably, such as the purchase of a building, sale of merchandise, or the payment of rent. This exercise, 1-21, shows you how the accounting equation can be used to analyze transactions. Okay? If we look at July 6th, Karen Smith, who opened a medical practice, during July, the first month of operation, the business titled Karen Smith, MD, PC, Professional Corporation, experienced the following events. Analyze the effect of these events on the accounting equation of the medical practice. So we have assets. She has assets that have increased. That would be cash. She has common stock that has increased. So in this particular transaction, she invested within the business. If you look at the balance, we have $55,000 on the assets. We have $55,000 on the other side of the equation, liabilities and equity. Okay, the next transaction on the 9th, she purchased land for cash. Cash decreased $46,000. Land increased $46,000. Now both of these transactions were on one side of the equation. So if we look at the big picture, both sides of the equation are in balance. The 9th learning objective is to prepare financial statements. This is where financial statements, they're business documents that report on a business and monetary terms. This is where the users are going to be focusing on these financial statements and making their decisions. We use financial statements to make business decisions. After analyzing transactions, we want to look at the overall results. The financial statements summarize the transaction data into a form that's useful for decision making. As we discussed, the financial statements there are 4 of them. We have an income statement, a statement of retained earnings, a balance sheet, and a statement of cash flows. Each financial statement and every other financial document you'll probably ever see has a heading that provides three pieces of data: the name of the business, the name of the financial statement, and the time period. So it's always going to be who, what, when. The income statement is the first statement that can be prepared because the other financial statements rely upon the net income of this. So if you'll notice, we have who, what, when at the top, Smart Touch Learning, income statement, month ended April 30th, 2013. The income statement, also called a statement of earnings or a statement of operations, presents a summary of a business entity's revenue and expenses for a time period, such as a month, a quarter, or a year. The income statement is like a video, a moving picture of operations during this period of time. It displays one of the most important pieces of information about a business. Did it make a profit? The income statement tells us whether the business enjoyed a net income or suffered a net loss. It shows the bottom line, which is the net income. Net income is the company's revenue minus its expenses. If expenses are greater than revenue, it's called a net loss. The income statement is the first statement that needs to be prepared because the other financial statements need net income to calculate their statements. A monthly income statement or statement of retained earnings is the next one that would actually be prepared. The statement of retained earnings shows the changes in retained earnings for a period of time, such as a month, a quarter, or a year. Retained earnings is when a business has net income, revenues exceed expenses. Retained earnings decrease when the business has a net loss or declares dividends for the shareholders. The next statement that is prepared is the balance sheet. A balance sheet lists a business entity's assets, liabilities, and stockholders' equity as of a specific date. It's usually the end of a month, a quarter, or a year. The balance sheet is like a snapshot of the business. If you look at cash, whenever we have cash, and if you think about any business at all, how many times is cash going to fluctuate up and down and up and down? When you look at cash, what we're saying in a balance sheet is click, here's our snapshot, here's what it was at this given point in time. The balance sheet mirrors the accounting equation. We're looking for that balance before we move on. The next statement is the statement of cash flows, and this reports the cash coming in and which are positive amounts, and the cash going out during a time period. Business activities result in a net cash inflow or a net cash outflow. The statement of cash flows reports the net increase or decrease in cash during a period of time. Note that the asterisk in the statement of cash flows indicate that we will learn how to prepare this statement in a later chapter. This concludes lecture number 2. The next lecture will be actually working through a problem and showing you how to complete all of this in the accounting cycle.